Welcome to UQ Alumni's very first Get Finance Fit webinar of the year. Please take a moment also to read the disclaimer slide that was on there before, and remember that what we discuss tonight is general information only. I'll now begin with an acknowledgement of country. The University of Queensland acknowledges the traditional owners and their custodianship of the lands on which we meet. We pay our respects to their ancestors and their descendants who continue cultural and spiritual connections to country. We recognise their valuable contributions to Australian and global society. My name is Genevieve Nolan. I'm a member of the UQ Young Alumni Advisory Board for 2022. Thank you so much for joining in this evening. We're so excited for this evening's content, particularly because of the stellar panel of experts we'll be hearing from this evening. First up is Effie Zahos. Effie is a UQ Bachelor of Economics graduate and is one of Australia's leading personal finance commentators with more than 2 decades of experience helping Aussies make the most of their money. Andrew Courtney is a Master of Commerce graduate and fell in love with the idea of financially educating people as a medical researcher studying breast cancer. He has since transitioned out of science and is now running 2 businesses, Plentitude Wealth and Plentitude Lend, a financial planning firm and mortgage broking business. And Dr. Christoph Breidbach is a senior lecturer in business information systems and is co-lead of the UQ Service Innovation Alliance. Dr. Breidbach's publications consistently appear in leading outlets, including the Journal of Service Research and Industrial Marketing Management. And with that, I might pass it over to Christoph to kick us off.
Great. Thank you so much, Jen, for the introduction, and good evening. So what we're going to do in the next 20 minutes or so, we're going to talk about 5 ideas that I think are relevant for the future of finance. And then hopefully those 5 ideas that I want to leave you with should give you an idea as to whether or not you should bet or invest in Bitcoin or any other DeFi or crypto assets in these challenging and unstable times. Now, here's my first idea that I have for you guys today, and that is digital technologies have transformed financial services for a long time, and they will continue to do so. Here's the thing. One of my earliest memories as a child, and I would have been maybe 4 or 5 years old, was going to the local bank with my parents. And I loved it because there was always this little nook with toys that you could play with. And mind you, that's the mid and the late 1980s. But the local branch, that was the local bank, right? So my parents had a bank account there. My grandparents had a bank account there. I had a bank account there. And the folks who worked there were just locals. So everyone knew everyone by name. And once you were done, you left the premises with cash, coins, and paper bills. And then, of course, technology came along and changed things quite substantially. ATMs and online banking essentially allow us to conduct our banking business 24/7 wherever we are, right? So I don't know about you, I have not set foot into a branch in years probably, right? If I do things, I do it on my phone. There is an app for that. And banks tend to throw new types of technology at us as customers. This is an example from ANZ in New Zealand, and they have this AI-enhanced personal banking application, essentially a service robot, if you will, that creates the illusion of interpersonal contact, but in fact, you're still talking to a machine and you're still doing this whole self-service thing. So that's sort of where we are right now, but things are changing. And what's really changing is the emergence of a technology called blockchain. And blockchain, I'm sure most of you would have heard of by now. It's really risen to prominence, especially in the last 5 years, I'd say. And it's the technology that's underpinning all cryptocurrencies, decentralized financial applications, NFTs, right? All that works on the blockchain. Now, blockchain as a technology ultimately has the potential to make financial institutions as we know them obsolete. And if you want to think of blockchain in the most basic sense, it is a network of individual computers that's distributed and decentralized. So in the classic sense, there is no such thing as the blockchain. There are multiple blockchains for specific applications, but they don't belong to anyone, right? And can contribute. So if there is a specific economic transaction that someone likes to make, so you would like to send a Bitcoin or a fraction of a Bitcoin to a friend, you can do this. And once you initiate that transaction, every single computer in the network, the nodes, have to assess and validate that transaction. If they all say, yep, that's okay, that's going to take place, and it's legit, then a new block is created. And the block is essentially a permanent record of that transaction that you just made, the Bitcoin that you just sent to your friend, and ultimately gets attached to the existing blocks in the chain. And so that's what it is. A blockchain is a digital representation of activities and or things that exist. And these things that exist can represent a piece of art, and you have an NFT, a non-fungible token, or it can be a Bitcoin, right? And that's the thing with these blockchain technologies. They are so transformative that even the incumbents are jumping on this right now. So this was released just 10 days ago, in that being the first bank to mint an Australian dollar stablecoin. It's going to be super interesting to see what happens with that. Now, I want to talk a little bit more about Bitcoin, because Bitcoin is really the application that most folks these days associate with blockchain. And it turns out that it's really quite prominent and common. So here in Queensland in particular, we had Australia's very first digital currency town, Agnes Water, and the town of 1770. Around about 2018, they made the collective decision to shift or enable economic transactions in that place through electronic currencies, digital currencies. So you can now go to Agnes Water and pay for your surf lesson with Bitcoin, or for your coffee, whatever you want to do. And we actually did an empirical piece, research piece there. So one of my PhD students went up and she did a ethnographic study. Good news, she is defending her PhD thesis next week. So that's gone very, very well. And we have the first paper published on that as well. But it's not just in Australia. We also have international businesses. So Microsoft, AT&T, Starbucks are all accepting crypto as payments right now. And in the intro survey that we ran just before I started talking, I actually saw that most of you are from Brisbane, which is great. I was curious when I put those slides together, and it turns out that there's a whole bunch of places in Brisbane and in Queensland more generally, where you can now pay with crypto. So there's a crypto cafe in New Farm, a Korean restaurant in Fortitude Valley, tapas place in Barden, right? So I have not been there. Don't take this as endorsement for their food, but these things are becoming more and more prominent. And as things become more prominent, interest in these technologies or in Bitcoin increases, and obviously it becomes something that people want to invest in. So once again, I looked a little bit into the data, and it turns out that in the last decade, so starting in 2012, if you had invested money into the S&P 500, you would have realized a cumulative return of 216%. And that's really not too bad, but it's absolutely nothing in comparison to the cumulative returns that you could have generated with Bitcoin. Right? It is ultimately, or some people call it, the asset of the century. There's no single asset, property, shares, what have you, that generated returns comparable to Bitcoin. And of course, that raises the question, why? Why is it that Bitcoin or digital assets are valuable? And that brings me to the second idea I want to introduce you to tonight. And that is, all forms of money are socially constructed. They're valuable because we believe it to be valuable. And ultimately, that social construction of money is very much context dependent. Right now, we're talking about Australian dollars, we're talking about Bitcoin. But if you lived a few hundred years ago in a completely different place, your perception of what is valuable would have been very different. So, for example, 15th century Mesoamerica, cocoa beans were used as currency. And it turns out that about 8,000 cocoa beans got you one turkey. Seashells were used in 13th century Nigeria. And if you are employed by any organization today and you are receiving a salary for the services that you provide, then you can thank Roman legionnaires. So Roman legionnaires received salt as part of their monthly allowance, working for the empire, I suppose. And the word sal is Latin for salt, salarium, that's what they got. And that ultimately developed into the word salary that we use today. Now, of course, today, if any employer would offer you salt or seashells or cocoa beans as salary, you probably wouldn't take it. And at the same time, if you could travel back in time and wave your $20 Australian dollar bill in some Mesoamerican market, you couldn't do anything with that either. Again, this is where this whole element of social construction comes in. But regardless of the place and the time that we live in, there are some attributes that are commonly associated with assets being valuable. And so the first one is scarcity. Is something readily available? If it is readily available, then typically we do not consider it to be valuable. To be an intermediary for any type of economic transaction, that asset has to be divisible. So you have to be able to turn this into smaller units. It has to be accepted by others. It has to be portable. After all, you need to get it to the market or wherever you want to engage in that economic transaction. It has to be durable over time and resistant to counterfeiting. And if we take those attributes and we apply them to any fiat currency, be it the Australian dollar, the US dollar, the euro, and scarcity ultimately is very low. Right? We can print, or we currently do print the money faster than we can spend it. And this is where the whole idea of inflation comes from. Any fiat currency is moderately divisible, very high acceptance rate, but portability is relatively moderate. And I do say this because as soon as the sums get larger, I think you need a really big suitcase to transport a few $1 million from place A to place B. And ultimately, very low durability. Coins and cash needs to be replaced, and it's not very resistant to counterfeiting, which is why for centuries we have used precious metals, usually gold, as a store of value. Today, its scarcity is moderate, but as a means to facilitate any economic exchange, it's not great because it's not very divisible, it's not widely accepted, and it's not portable, right? You can't carry those gold coins to the shop, and if you do, then it's going to be pretty heavy pretty soon. It's quite durable, and its resistance to counterfeiting is high. Which brings us to Bitcoin. Now, the great thing about Bitcoin, its scarcity is extremely high. 21 million Bitcoins to be precise. That's all there ever will be. And we know already that around about 3.5 million Bitcoin have been lost. And have been lost, that basically means people lost the hard drive or they forgot a password or anything like that. So really, we're only going to have around about 17 or so million Bitcoin, or maybe even less if we keep losing them. Really high divisibility. So Satoshi is the smallest unit of a Bitcoin. It's increasingly accepted, as we've seen, even here in Brisbane. Very high portability, because ultimately it's a digital asset. It's completely immaterial. You can send it anywhere, anytime. Very durable and extremely resistant to counterfeiting due to the consensus mechanism that is inherently enabling the blockchain. Okay. Now, that brings me to my third idea that I want to leave you guys with tonight. And possibly this is the most important one. Idea number 3 is we are just entering the age of true digital finance. And I'd like you to think of it like the internet in 1998. Okay, the internet in 1998. I don't know if you've been around and used the internet in 1998. I think I got my first AOL dial-up modem in 1998 or maybe 1999. And today we have, give or take, 200 million crypto users worldwide. And that is basically the equivalent to internet adoption in 1998. Now, I don't know if you remember, again, the internet in 1998. If you don't, then here's a bit of a blast from the past. This is what Google looked like in 1998. AOL.com was all the rage in 1998. Amazon, you can see this little ad here, was just a virtual bookstore, and all the things that we use today, the Instagrams, the social media, Facebook, a Zoom lecture, digitally facilitating hundreds of people at the same time on a Thursday evening, was completely unthinkable 20 years down. And some of you might use an iPhone or a Samsung phone. This is what computers looked like in 1998, right? It was essentially a completely different environment, and yet we got to where we are right now. So let's just assume this is where we are with crypto. We are so early that the majority of the structural changes we're going to see through crypto, I think, will be identical to the structural changes we've seen thanks to the internet. So there's probably going to be a boom and bust cycle like we've had with the dot-com boom in the early 2000s. And what that probably also means is that 98 or 99% of all crypto projects or NFTs will cease to exist, and they're just going to disappear into oblivion. But some will stay, and some new ones will emerge that will completely change the way we engage with finance and with money. It's essentially the challenge to figure out what is the Google or the equivalent of Amazon today in the crypto space. And if you can invest in those, then 20 years down the line, you'll be very happy. All right. Now, that sounds cool, but it's unfortunately not all that beautiful. There are some dark clouds on the horizon, which brings me to my next idea. The thing about decentralized financial services is they are democratic and they are accessible, and that's because of collective social actions. As you may know, Bitcoin was developed by this gentleman, Satoshi Nakamoto. That may be a pseudonym. We don't know who he is or who they are. It might be a group of individuals. If we want to continue to benefit from decentralized financial services, the thing is, we all need to play a part in the future. And this brings me to another study that we did a few years back, and we actually worked with cryptocurrency communities at the time in Melbourne, and we tried to find out who are those folks and what is it that they do. And what we found out that there's essentially 4 ideal types, roles that people play. There are freshmen, those who are new to crypto, they want to learn and really get their feet wet. We have idealists, those are crypto aficionados. Academics, often individuals who are trying to share their knowledge and their ideas about cryptocurrency and who see the benefits of decentralized finance. We do have fortune hunters. Those are the get rich quick kind of guys. And then the most interesting group are trailblazers. And trailblazers essentially combine the characteristics of fortune hunters in that they are economically oriented, and idealists in that they have unique skills and ideas. And they're typically the ones that start new businesses in that crypto space. And they ultimately, and that's what we've been able to show in that piece, are able to positively influence the functioning of crypto markets, the market offerings, and the size of the market. Now, this is again a paper I believe we are able to share with all of you after the session, and then you can read it if you're interested in that. Here's the problem with all of that. Everything that we've seen so far in the crypto space has been a bottom-up social collective process that is very much developed and grown organically. And this whole adage of if you can't beat them, join them is really what we're seeing right now with a number of governments around the world, unfortunately, including the Australian RBA. And the term that's commonly here used are central bank issued digital currencies, or CBDCs. There are some of them already available. the e-naira in Nigeria or the Gemdex in Jamaica. And essentially what it is, it's a digital fiat currency issued and controlled by a central government, so the Federal Reserve Bank, the RBA or equivalent. And commonly those things are sold off and discussed in the sense that it fosters financial inclusion, it reduces illicit activities, helps with tax avoidance, and ultimately increases the efficiency of financial markets by reducing the need for intermediaries. And that is important because ultimately what that means is you would no longer have a bank account in the classic sense with ANZ or Combank or Westpac, but you would have an account with the RBA. And the RBA would then issue CBDCs into your account. For example, as a universal basic income. Now that might sound good, but the problem is that a CBDC, due to its technological properties, is something that we call programmable money. And programmable money actually means that the central authority, whoever that is, has the ability to restrict transactions across temporal, spatial, and individual boundaries. So put differently, they can control when, where, and who that money gets spent, or these tokens get spent, right? So you could, for example, say, you need to spend those CBDCs by the end of the month. If you haven't spent it all by the end of the month, they will just expire and you can't spend them anymore. The consequence of that is, once you become dependent on CBDCs, you can't engage in saving. If you can't save, you typically also can't invest, and you become entirely dependent on that central, potentially authoritarian government. The spatial constraint means, where can you spend the money? Now, the state government might issue a stimulus check and say, hey, spend this money on holidays in southeastern Queensland. Again, sounds good in this particular setup, but it could also be used to restrict where the money can be spent in a permanent basis. And that means it restricts the ability of individuals to move, because if you have money only from that CBDC account, and if it expires and can only be spent in Queensland, that would essentially remove your ability to move to, say, Victoria, because you don't have any funds in Victoria, or to another country. And then last but not least, the individual constraints, who can that money be given to? That basically means, again, from the perspective of any government, undesirable properties in society can be removed. And that might be, you can't spend the money on alcohol and tobacco products, okay, fair enough. But you could also say, in a very extreme case, and this is entirely constructed here, of course, a Labour government might restrict your ability to provide political donations to the Liberal Party. That's an example for individual boundaries that can exist. So surveillance control and limits to free market participation are ultimately the consequences, the potential consequences associated with CBDCs, which brings me to my last idea, and that is, I think it is absolutely pivotal for all of us right now to embrace the change, but to learn as much as we can. I strongly suggest you really start reading up on anything related to blockchain, digital finance, CBDCs, cryptocurrencies, and be open to new opportunities, not just from an investment perspective, but also from your general duty as an informed citizen. From an investment perspective, it's really simple. If you don't get it, forget it. And if you would like to know more, I have included a few links here for you, and those are contributions of mine. Again, this is a very small snapshot, and there are, of course, many other great contributions, but those are the ones I contributed to recently in ABC News, UQ Momentum. I did a piece in CanStar, as well as some academic work that you can access. So I'll stop talking here. Thanks again, guys, and I will hand things over to the next presenter, which is Effie.
Hello, hello. Thanks so much, Christoph. Okay. Look, I found that really interesting, and I know Andrew after me is kind of going to make sense of where all this sits, because I guess I'm going to come in now and give you more so the traditional route. Could be boring, could sound boring, but it's basically looking at, I guess, the more traditional asset classes and how to start investing. So look, I guess I'd like to start off with essentially giving you a bit of an idea of what's happening at the moment, because there's a lot of noise. I mean, as far as my role goes, I do report every day. You'll find me on Today's Show or through even CanStar on basically money matters. So what's really hitting people's hip pockets. And when it comes to investing at the moment, there is a lot of noise. There is a lot of fear. Other people are taking opportunities, as Christoph did point out, take advantage of what is happening and understand what's happening. So at the moment now, we're looking at a situation where we've got inflationary pressure, and that does impact investments. There's no denying that. I mean, we've also had a situation even today when a major bank has revisited its forecast with interest rates. So Westpac has come out and basically saying that the RBA, because of inflationary pressure, will probably be forced to move rates in June. That is in agreement with the CBA as well. And CBA is forecasting the cash rate to be sitting at 1.25. The money market's actually forecasting up to 7 to 10 rate hikes. I think that might be a little bit aggressive. But what that does mean is that we are seeing a shift right now. And for mortgage holders, if you've got a mortgage, that's going to be really hard. For investors, it could mean also that different asset classes, again, will do better than others. But taking all that noise away, and I guess if you're jumping into the market, for me, what it is, it's an approach of basically taking the noise out and just having that steady plan. I've been an investor since probably the age of 18 into the share market. And in different formats as my life has moved on. I have 2 kids, a 21-year-old who's actively investing in ETFs herself, and I've got a young boy, 14, 15, and he's also investing in ETFs. And I will talk about those a little bit, but the most important thing is I just want to run through, first of all, for me, what I consider would be some very simple rules of investing. And that is essentially, you do need to have a plan. You do need to have a conversation with yourself. And you need to understand what is it that you're trying to achieve. And it's important to note that you actually don't need a lot of money to get started when it comes to investing. And for point 2, that's really important. It is about saving little, but saving often when it comes to investing. It's also really important to watch the fees. Fees can be the biggest kind of setback for you, especially when you're investing in things like that track and index, because the most important thing is that your returns are going to be pretty much the same no matter who you're kind of investing with, if they're tracking an index. But what will make the difference is the fees. And I'll touch on a little bit around that as well. The other thing is to understand, if it sounds too good to be true, it probably is. I mean, a lot of people use that saying. It's very simple. We're looking at right now, cash in the bank earning next to nothing. So if an investment's coming along and saying you are going to be getting a return of 20%, you've got to question, well, what risk do I have to take to get that return? And the next one is never invest in anything you don't understand. Whilst you do not have to understand the workings inside out intrinsically, you don't need to know everything about it. You do need to understand the fundamentals, and it goes back to that risk for return as well. And of course, never think that you should never take on expert advice. Some of the best investors, or even, in any circumstance, do require help from professionals. So I do advise you to actually take that on board. And the good news is there's different formats of advice as well. Anything from, your traditional financial advisor right down to Roboadvisors as well. So if I can just move on to the next slide, I want to talk a little bit about this compound interest. This is that going back on to save little, saved often. Shane Oliver actually has the economist for AMP Capital, does a great little newsletter that I read often, and he's just published this, and it was his favourite graphics that I thought were really interesting. A lot of this is not new, just put together different formats and different ways, but it just goes to show what the power of compound interest has. And that was that point I was saying before, save little, saved often. You don't need a lot to do that. This shows what the value of $1, we're talking $1 here, would be if you invested back in 1900. Now, that's a long time ago. I get that. But I guess for illustrative purposes, what it actually just shows is just how powerful that interest on interest can be. I mean, if you had it in cash, you'd only have $242. Had you invested into the Australian share market, you'd have just under $800,000. I mean, that's not doing anything more than just putting $1 away. You can see the return with bonds and cash there. It's only just half virtually, but the difference, 922 versus 788,000, it's huge. And that is the compounding effect. And that really is what you want to get to. You actually want to get to a situation, because you're saving little and you're saving often, where the interest is doing the heavy lifting and not you. So your money is working smarter. And to give you an idea, then the next slide shows the different asset classes that you can actually invest in. So this is just Vanguard. Have a play with it. They've got this online and you can put different filters and just see, what if I invested when, you can choose the periods. I've chosen a 10-year period here just to show the different asset classes. You can have a look at Australian shares and Australian property. There's always that big debate, shares versus property. There are pros and cons for all types. Pros and cons depending on which one you're going for. But it's interesting with the property market, we have just seen that go crazy, absolutely crazy. The last year, property has probably gone over 20, easily over 20%. If you look at some CoreLogic data. Will it continue that trajectory? Probably not. It's quite interesting, as I was saying before, with rising interest rates and a slowdown in property markets. Sydney and Melbourne has shown month-on-month drops. Interesting, the Brisbane market is still going strong, and so are regional markets. The Brisbane market, of course, you're basically getting a whole lot of net migration, people moving out of Melbourne and Sydney coming to live there. You've got the Olympic Games, so there's some sunshine definitely happening there with property. But you can see here that, in the long term, the average returns here for shares have been about 9.6, property about 11.2. And it gives you a good idea when you actually are planning and just seeing that, there is a lot of noise. There is a lot of things happening. But I guess, it really does come down to time in the market, which is actually a nice segue to the next slide, that I myself do not try and pick the timing for when I invest in. I'm a sure and steady kind of person. For me, I make the most of the money that I have and the most of my investment opportunities. So I know by dipping in slowly but surely, my goals will be reached, and I plan for that. And you can see here, this actually is what Shane Oliver calls the wall of worry. And I love it. Again, this is not new. There's a lot of graphics out there, but I like the way this has been put together. And it really does show that, we had COVID. Remember when COVID first hit in 2020, and then March, the share market plummeted. You can see there overall about 37%. It was really scary times. If you've never actually experienced something like that, I've been old enough to be in these tech wrecks. I've been in a few of these crises actually. And so for me, I know it's a buying opportunity and a rebound that happened. For me during that period, I can tell you now at my age, I was dipping more money into my super. I was salary sacrificing to the max, $27,500 per year there. And I was putting extra, and I top up my super by BPay, like a bill, because I know I'm buying at a rock bottom price, so to speak, that the market will turn. And it's interesting with superannuation, because it's a diversified asset. It's not just in one kind of asset class. If the market falls about 10%, you can expect a super fund to drop about 4% as well. But you can see COVID wasn't actually the worst of the crash there. You had that OPEC crisis, minus 59. You've had the global financial crisis, 55. They're huge drops, but you can see what's happening over time. It's going up. I think one of the most important lessons I've learned is that it only becomes a loss if you have to actually sell or realize that loss. At a stage, it's only on paper. So for most of us who can afford to ride out the bumps, if you buy good quality assets, you will do well in the long term. But it's important, and the next slide shows the importance of fees. Now, just full disclosure, I do sit on the board for InvestSmart, and this is a paper that they did. It's a robo-advisor. And it's a little bit old because obviously the investment returning here is at 9.2%. That's quite high. But putting aside the investment returns, I wanted to show you the difference of when you hear, oh, it's only a 1% different in fees, it does not really matter that much. It actually does. And you can see how much you would lose to fees if you were paying, 1% more. I mean, obviously nil is the goal. Very unlikely to find an investment that doesn't charge any fees. But you can see the difference between 1, 2, and 3. And I guess for me, why I do like ETFs, and if I can get to the next slide there to show you, and I'll explain just briefly what ETFs are. So ETFs, for a lot of people, basically are a simple way to invest in the share market that doesn't require you to go directly. So a lot of people, if you've got short on cash or you don't have the time to jump in with, say, $500 and buy one stock, it's not going to give you that diversification. And also you've got to know what you're buying, whereby this way you say, okay, I'm happy to leave it to the experts. So you put in some money, I put in some money, and basically this money sits, think of it like in a grocery basket. And depending on what ETF you're invested in, what it tracks, and it's listed on this ASX, so you kind of buy and sell like, individual shares, but you don't own those shares. It's actually, you've got a trust in it, a unit trust of it. What that actually does is that you're relying on them to make the decisions for you. It tracks an index, let's say it's the ASX 200. So it can only do as well as that or as bad as that. And you do pay a fee, and the fees are very nominal, very small. So, if you're looking at some fees and, it's only 0.03%, can you imagine if you've got $1,000, you're actually only paying 30 cents a year for that fund to manage your money, and you get that diversification. You get all these securities under there. So this just gives you an idea. Of course, I've got to say here, past performance is definitely no indication of future returns. This just shows what's happened in the past. But some of these are some solid names that have been in the game for a long time as well. So you can see here, these are just broad-based. I actually asked CanStarters to crunch some numbers here and show me the best performing ETFs over the past 3 years here and 5 years, and obviously 1. And you can see here that, these are solid, good returns. I mean, money in a bank account right now, you'd be lucky to get 1%. So it gives you an idea of what's out there. And then, of course, you've got international ones as well, which is in the next slide to show you the top performing ETFs on international funds. So that gives you a bit of overview. For me, there's no it's not rocket science. It's not that hard. When it comes to investing in the traditional format, if you're willing to, not time the market and take it that way, then there are only a certain number of ways that you can invest. You either invest in yourself, which is the most important thing. Also, you can invest in property, either directly or indirectly. You invest in cash against indirectly or directly. You've got fixed interest. You've got bonds. There are only a certain amount of things that are out there. And it's a case of just actually getting across what they are and how they work. The beauty about it at the moment now is that we are spoiled for choice with products. My kind of word of warning here is do take a look at the products and what fees they're charging. I know there's a lot of micro investing apps out there, and I think they're great. I do love the idea around the fact that, you can spend and invest at the same time. You can tap and go, and you can have roundup accounts, and these roundup accounts put your money from your cash account and they invest into an ETF, which, they'll probably invest in some of these themselves, of course. The only tip there again is watch the fees. They do seem small, but when your balance is small, it makes a huge proportion of your investments, and that can really eat away. And also, when it comes to investing in something like ETFs, if you want to regularly invest, again, because I was saying it's like buying shares, you will be charged a brokerage fee. So just take care about how they structure that as well. In some cases, you may be better off waiting to make more of a lump sum deposit in there rather than just throwing $20 here and there because of the fees involved. But that gives you a very quick roundup of traditional ways to kind of get in there. And I'll hand it over to Andrew to kind of put everything we've said together.
I'll try my best. Can you hear me
Sure.
okay? Awesome. Okay. All right. Let me share my screen with you guys. So hopefully you've learned a whole heap of stuff, and I'm hoping to bring it all together for you so that we can wrap it up in a nice little package. Okay. So what we want to do here as investors is start with the end in mind, right? So why are we investing in the first place? Ultimately, right now we are basically trading our time for an income. Right. And the idea is to earn enough income, so much so that you can actually create a surplus for yourself. Right. And that surplus becomes your capital. There are two core things that your capital can do. Right. It can provide your return on investment, i.e., an income return on investment, or a capital gain where you can keep growing your capital. Right. Now, why do we start with the end in mind? Well, ultimately, what we're trying to achieve is build enough capital, so much so that it produces an income that replaces what you're currently earning, or maybe some of what you're earning, or maybe more, depending on how ambitious you want to be, right? So what I suggest you guys do at the moment is have a think about, well, what kind of capital position would you actually need, right? What's the dollar amount that you need to produce the income that you want, right? So a good rule of thumb is, well, what kind of salary are you earning? Let's say you're earning $100,000. And if you're trying to replace 100K of income, right? What I suggest you do is have a think about what kind of returns you can aim for with your capital, right, to produce that kind of income. And what I suggest you do is start off with 5%, right? So what you do is you go 100 times 20, i.e. 5% return. So you would need $2 million worth of capital invested at 5% return on investment to get the income that you want to replace your original 100K, right? So that's one thing that I would suggest you do, you think about. Set a target for yourself and ask yourself, well, what things are you taking action towards, or what consistency in action are you doing to actually achieve that capital target? And how long will it take you, right? Because if you're saving towards $2 million, and if you can only save $10,000 per year, well, you're going to be in trouble, right? So you're going to need to be a little bit more strategic in your approach to actually speed up the process of hitting the ideal income, right? Ideally in retirement, or I call it financial freedom, right? Where you got enough capital that produces enough passive portfolio income so that you get to choose to work rather than be forced to work. Big definition, a big change there, right? So next slide here is which graph depicts your financial situation, right? So your net worth is the y-axis and the time is the x, right? Unfortunately, most Aussies do not invest whatsoever, and they will never actually achieve hitting their ideal income, i.e. that $100,000 goal that their target is, right? Because they're never going to get to $2 million. It's just not available to them. They're not saving enough on a year-to-year basis. The next Aussie is arriving. They will get there, but unfortunately, they have to wait 50 years, right? Because all they have is one lever, and the lever is to save money, and that's all. Put it in a bank account and hope for the best. 1% per annum, as Effie mentioned, right? Number three are the ones who are now investing, right? So instead of a 50-year time frame, they're now saving some years, right? The ideal income is now in sight, right? So they may save themselves 10 years to go from 50 down to 40, potentially 20 years from 50 down to 30, right? Because they've started investing. They've looked at Bitcoin, they've looked at crypto, they've looked at shares, they've looked at property, and start to build up a portfolio where they start to basically get lift off from the trajectory of the 50-year trajectory, right? So they get there and they save themselves, let's call it 10 to 20 years. Fantastic, that's great news. And then the last one is the thriving, where they're racing towards their ideal income because they're strategic in their approach, right? They understand what levers they can pull in the marketplace, and they can actually make strategic moves and ultimately utilize the resources that are available to them and maximize it accordingly to build a solid foundation and the vehicle that they want to actually achieve financial success a hell of a lot faster, right? So the goal here is to go from a 50-year timeline down to a 30-year timeline, and in an ideal world, a 15-year timeline, right? So how do you go ahead and do that? Well, you've got to come to these kinds of webinars, right? Educate yourself, read a ton of books, understand your options, and start taking action towards building a better future for yourself, right? So what you ultimately want to do is ask yourself 3 core things every single quarter or every single year, depending on how ambitious you want to be, right? Ask yourself the beautiful question of how can you save more, reduce your taxes, and invest better, right? And what I want to do is I want to focus on how can you save more? Well, there are 2 core things you need to do, right? You need to lower your costs or your expenses and increase your income, right? Far too many people forget about this thing, right? If you can increase your income, well, ideally, if you do both, right? Most people are focusing on lowering their costs, right? So what I suggest you do is have a think about what kind of skills you need for your next promotion. What kind of skills do you need to amplify the effect that you have in the marketplace for you to be highly in demand for your career, right? So once you start asking these particular questions, then you're going to ask yourself, well, is $1,000 best spent in a, let's say, an ETF or crypto, versus is $1,000 spent on acquiring a new skill that will complement your current skill set, thereby allowing you to earn more? Maybe, just maybe, you may be able to get a higher return on investment on your capital, right? Because what you're doing is you're utilizing your capital and using your time and creating a skill out of it, and suddenly your labor becomes more highly in demand, right? Therefore, you can get more from the marketplace, right? So something to consider for you guys, right? And then if you ask yourself these particular questions, how do you invest better? Suddenly you can hold yourself accountable to what you've done in the past. And please do not compare yourself with others, right? Run your own race. Make sure you hold yourself accountable and audit what you've done in the past, right? So the next thing, the trap that most people fall for is this. They take action without really understanding where they're heading towards. So understand where you're going, know where you are, know where you're heading towards, point B, and start creating a strategy, tactics, and setting milestones for yourself so that you can actually take the right action steps to achieve that particular outcome that you want, right? So what you want to do is you want to create that vision, build a strategy, understand the tactics that are available to you, create some milestones for yourself, and then take action. Far too many people are jumping on the action step, not realizing that they're actually going backwards and going forwards, and they just keep going backwards and forwards and backwards and forwards, and they never actually get ahead, unfortunately, right? So that's where planning comes into practice, right? So back to the skill stacking piece, right? Ultimately, you want to start building skill number 1, 2, 3, 4, and 5, right? So that you can get a synergistic outcome, right? Where you can start to demand a higher price for your labor, right, in the marketplace. And ultimately, it comes down to what problems are you currently solving, right, for your workplace, for the people around you. Because the bigger the problem, the harder the problem that is that you're solving for people, the higher the income that you can demand from the marketplace. Hopefully that's making sense, right? So in terms of the portfolio construction, so obviously we talked about crypto today, we talked about shares, talked about a little bit about property, right? So what I always talk about is this, right? Within the portfolio construction, the investment journey looks like this, right? A lot of people, and this is how I typically like to create portfolios myself, right? We want to focus on growth investments to begin with, because during this time, we are actually working, right? And we are earning an income ourselves, right? Therefore, you don't particularly need much income when you're currently working, right? Because what happens with more income is, we all know this, right? We get taxed. Therefore, ideally, when you're building a portfolio to begin with, you do not want to be complementing your income unless it's for a strategic purpose, right? So a good rule of thumb is to aim for growth first and then transition from growth into income producing assets when you're ready to rock and roll and pull more income out of your portfolio, right? So back to the $2 million scenario. So right now we're starting from $1,000, right? And the goal is to get to 2 mil, right? If you start to aim for an income producing investment at 5% conservatively, right, year in year, well, you won't really have much of a chance to get to 2 mil over the next 15, 20 years, right? Because 5% is nowhere near enough, right? You need to start to take a little bit more risk, right? Enter the different kinds of investments you can make, right? So at the very, very start of the process, you may want to consider, well, the higher risk, the riskier assets for the higher return, right? And what you may want to consider as well is diversifying across multiple asset classes. So if we look at it from a perspective of low risk, low return, the defensive asset class is basically your cash. So ideally, you want a buffer in place, right? Get a buffer, right? And make sure that you're safe. You got your emergency money, right? The next one, fixed income, right? It's a little bit higher than cash, but not exactly crash hot, right? You may be able to get 2 to 5% return on investment on this. Now, property, as Effie showed before, you can get 11.2 shares, sometimes 13, sometimes 17, sometimes 9, right? It all depends. But as you go up the chain, what happens is your risk gets higher, risk being the volatility in the marketplace, right? But the returns start to increase as well, right? Now we've got crypto. You can start investing in Bitcoin, Ethereum, a whole bunch of other altcoins as well. Or you can go DeFi or NFTs, a little bit more aggressive, right? This is the wild, wild west now, right? So you got to ask yourself, well, how much of your portfolio, if you've got $100,000, how much exposure do you want to choose? How much of that $100,000 do you want to put towards a higher, a more aggressive asset, right? And then the fastest way to build wealth is to build a business, right? So unfortunately, it's obviously one of the highest riskiest things you can do as well, right? There's a reason why 9 out of 10 businesses fail within the first 5 years, right? Then if you really want to ramp it up, then you can utilize leverage, right? This is how you build strategic portfolios. If you understand how to, I guess, coordinate these assets and create a diversified portfolio, and when you know the risk that you're taking on, what happens is you start to build the plan to actually create enough capital so that you can actually systematically replace all or more of your income. Hopefully that makes sense. Always, always, always start with the end in mind when you're planning and when you're starting to invest, right? There are a lot of bells and whistles out there, but you have to ask yourself, well, what are you trying to achieve with this thing? How long do you currently have? Know your current trajectories, know your current projections, and make sure you don't project out with 20% per annum year on year, because you're going to be a billionaire in about 10 years time. It's amazing. I had that kind of light bulb moment when I turned 19. I thought, oh my gosh, my life's going to be different in 10 years time. So don't fall for that trap, guys. Make sure you project out with conservative assumptions so that you can actually achieve your goals realistically in a good time frame, basically. So thanks very much. We'll open it up for some questions now.
Very wise words there, Andrew. And thank you to all of our panelists for their insights tonight. We're running a little bit over time there, so I think our lovely panelists have agreed to stay on for a couple more minutes to get through some of those questions. And I do want to thank the attendees as well for actually submitting quite a few pre-submitted questions as well. So we'll begin with one of those and then head on to the live Q&A. So to begin, let's take it back to basics. How would you recommend learning how to start investing for the first time? As a novice, what do we need to do? Do we set up a trading account with our bank? Like, take us through the steps of how to get started.
I think Effie, you should take this one.
You want me to take this one? Okay,
Yes,
so
please.
how do you get started? It seems daunting, doesn't it? And it seems scary too, because you're parting away with your hard-earned cash and you're seeing it sitting there in your bank account. But remember, saving and investing are two different things. So what you need to think about is, what is the cost of not actually investing? That's probably a better way to think. What will I be missing out if I don't jump in, rather than worrying about, okay, what could I possibly lose? And, we've talked about the risks, so I'm not saying that, all investments are definitely 100% by no means. But I think if you're starting off, and I do say this quite a lot, fear of jumping in can be just as bad as fear of missing out. And a lot of people probably experience that. I know a lot of you are first-time investors now, and I saw a lot of first-time investors jump in. The market was so low. But I'm not about timing the market. Put timing out, put all the noise away, and just think, there's no better time than now. Do it now. So the situation is, for me, knowledge is power. So really do read up a little bit. Some great websites that you could start, obviously, moneysmart.gov.au. Very simple 101 on investing. I mean, I know myself, I work at CanStar. There's a lot of one-on-one articles on there as well. Just get educated. And like, if you follow some of those rules, what is your plan? What is your goal? What is your time frame? And then pick an investment in that area. If you're not confident about going directly, I did mention a couple of ways of going indirectly. Manage funds, ETFs, have a look at that. But the first thing first, really something simple. There are a couple of minute reads. Get onto the government's website, Money Smart, get onto the investment section and just see some of the options. And if you're still panicking, just dip in a little bit, put in 1,000, get the feel of the platform you're working on and have a go that way. But it's you've got to be in it and stop getting that fear of jumping in, stopping you from missing out on all these great returns.
Excellent advice there. Thank you so much, Effie. Now we've got a question from the floor. So back to crypto. Scams can be quite common. So how can this be regulated? And even if it can, should it be regulated? I might throw to Chris there.
Great question. So Adrian and the anonymous attendee essentially, I think, posted the same question. And it's a very common public narrative that we see right now. So crypto is used for illicit activities. Crypto is not regulated, and crypto is using a lot of energy for mining. This is why it's really bad and we shouldn't use it. Okay. Now, here's the thing. What I'd like you to think about is who is creating that narrative? And that narrative essentially comes from the mainstream financial institutions. And those are essentially the ones who have the most to lose from crypto. A truly decentralized digital asset like Bitcoin makes governments through RBA completely pointless, makes financial institutions like ANZ completely pointless. And so obviously there is a counter narrative emerging around that. Now, here's my response. Is crypto being used for illicit activities? Probably, but so is fiat money. Is crypto mining energy intensive? Probably, but so is international air traffic. Is there a lack of regulation in the crypto space? To some extent, but here's the thing. The Australian financial services sector is massively regulated. And yet in 2017, we had a royal commission on the misconduct in financial services and insurances. And the things that they came up with were absolutely mind-blowing. Like they sold insurance policies to dead people and scammed retirees out of their cash at NAP. So neither the regulation, nor the energy, nor the financial fraud argument, anybody remember Bernie Madoff, for example, are actually valid arguments against crypto. They're simply a counter narrative. Ignore it. That's my advice.
We've heard from the expert himself. Thank you so much. Next one, I'll throw to you, Andrew. Suggestions for low fee and reliable investment platforms. How do we get onto this?
Well, look, I think CanStar is the place to go, right, Effie? I mean, you just get on there and it'll break it all down for you.
Yeah, there is also, I know InvestSmart, which I do sit on the board, and they are a robo-advisor, have got up a website called roboadvice.com.au, and that basically compares robo-advisors plus links back to their own website. I mean, I've mentioned a few, and there's a few to have a look at. You've also got StockSpot, SixPark, InvestSmart is one. So these are robo-advisors in the sense they basically ask you to answer a few questions. They get a feel of your risk take profile and then would suggest some type of portfolios. And these portfolios are all made up of those exchange traded funds that I spoke about. And then they charge different fees on depending on who you go through. So I would advise maybe have a look at a couple of those, compare notes and see which ones would suit your investment style and the amount that you're investing in.
Thank you so much. And I'm going to jump to one of the questions that was asked before we started. So your general thoughts on the future of cryptocurrencies?
Here to stay. So it's not something that's going to go away. And the question really is, to what extent is it going to influence our daily lives? I think there are two extreme scenarios, and both are unlikely to eventuate. And the first extreme scenario, that's called one on the left, is a truly decentralized financial services system where we all run essentially our own show with some D-apps, and it's all going to be crypto. Banks and the RBA have disappeared. The other extreme end of the scenario is Bitcoin, Ethereum, etc. will be completely banned, illegal, and we're all going to be slaves to some CBDC. The truth is probably going to be somewhere in between.
I agree. I'm invested in crypto myself, so I do believe in the in blockchain technology too. So yeah, just like Christoph mentioned earlier, it's about picking the winners. So that it's a little bit early days to be able to know which one's going to be the winners, but it clearly Bitcoin's got the largest market cap when it comes to the cryptocurrencies available that you can invest in. But there's a whole bunch of technology, so you got to pick your I guess entrepreneurs and operators who've got good track records if you want to invest in that space as well, outside of picking up cryptocurrencies.
Wonderful. And we've got a question from Kelsey here about the connection between NFTs and crypto.
Yeah, great question, Kelsey. So the connection, the common denominator, if you will, is that both are driven by blockchain, the technology underlying them. And so blockchain is the enabler. Now, NFTs are non-fungible tokens, and that basically means it's a unique representation of a digital asset. Most commonly, or most people associate NFTs with, let's call it digital art. So the Bored Ape Yacht Club, the Crypto Kitties, and those are essentially JPEG images that have a unique identifier on the blockchain, and people trade them for literally hundreds and thousands of dollars. If you sort of go up into the somewhat higher echelons, there are now artists, and they have their work sold for millions of dollars on through Sotheby's, right? So $20 million for NFTs is possible. But that's again a very extreme outlier. NFTs are really quite variable, even beyond art. So, for example, there is now a restaurant in Korea, and they sell NFTs as a sort of membership club card. So you can get a free meal at the restaurant once a month as long as you own the NFT. Now, is that the reason to buy the NFT? Maybe, but maybe not. The real thing that's cool about NFTs is that there is a thing called a smart contract that's underlying the NFT, and that enables the person issuing the NFT to control certain properties. So, for example, let's say you have an art talent, right? You draw some sort of painting, you turn this into an NFT, and you sell it on OpenSea, which is sort of the largest NFT platform out there. You can specify in that smart contract that every single time that NFT gets sold from person A to person B to person C, a certain percentage of that proceeding goes back into your digital wallet. So essentially, you're continuing to earn royalties as long as that NFT gets traded. And that's, of course, a great way that we now see in the wider art community, in music, for example, that people use that to generate revenues. Also, what I've seen is NFTs being used for property transactions. So again, the whole property market might change substantially through NFTs. And I think, as I said earlier, there's going to be applications for NFTs that we don't even know yet about, and they're going to change one industry or another in, again, ways that are probably too early right now to fully apprehend. But that is, at the end of the day, a very short summary of NFTs.
Great way to finish. Thank you so much to our lovely panelists for providing a broad and deep range of insights tonight. Shout out to Effie. First up, you can read her book or listen to her new podcast on Spotify or wherever you get your podcasts. So thank you for joining us. Also to Andrew, who is absolutely killing it at the Instagram game at the moment, may I just say. So go and follow on socials and get some financial advice to put all of this stuff into practice. And thank you to Chris as well, who has got a plethora of articles and material available to go and read up on everything that we've discussed tonight. So thank you again to everyone for joining us. We've got our next event coming up next Tuesday, which is a budget recap, what all of those budgets announcements mean to you. And we hope to see you at the next Get Finance Fit. Thank you very much, everyone.